Give me that.
Crypto Quickie.
What is up, everybody? It's KJ here, and in this video I will be giving you 5 game-changing tips for trading Bitcoin and cryptocurrency for beginners. Even if you're not a beginner, definitely check it out because this is serious stuff that I'm going to be going over right here. We keep it to the basics, but it's like a lot of these rules and concepts are very simple, yet the majority of people don't follow them. So even if you're not a beginner, I hope you enjoy the video and get some value out of it. This is really powerful stuff that I'm about to share with you. And if you're serious about trading, it doesn't have to even just be Bitcoin. You can use this for any market. But if you're serious about it and you really want to make some money doing this, I suggest you pay very close attention. As always, this is not financial advice, and I always want to thank my sponsors over at Dudex. That's a Bitcoin leverage trading exchange. So without any further ado, let's get into it, okay? Rule number 1, risk management and stops are so important, okay? Some people don't know about risk management. Some of the newer people, they just go all in all the time. What does risk management mean? It means that you are defining how much you stand to lose with every single trade. And you don't want to, I mean, everybody has to decide that on their own. But the main core concept is that instead of trying to take a gambler's approach and get lucky and win some one crazy trade, you want to, pace yourself and leave room for being wrong. Nobody gets it right every time. Especially when you start trading with margin and leverage, you can't be wrong by too much or else you're going to get wiped out. So, one good rule of thumb is, you don't really want to be risking more than 2 to 3% of your trading stack per trade. And a lot of people don't follow that rule. Most people are using more than that, but that's why most people get wiped out. Never underestimate how many times you can be wrong in a row. And if you're risking 10% or something like that, or even higher, God forbid, and you lose like 3-4 trades in a row, you could be out of the game very, very quickly. The other thing is you hear about people that and I'm sure I've been there. A lot of these rules are mistakes that I made. I had to make these mistakes. Unfortunately, it kind of reminds me of my parents. I had good parents. They gave me great advice as a kid, and I was hard-headed, and I didn't listen to all the things they said. And it's like I look back, 10 years later or 20 years, whatever it is, I'm like, damn, I should have listened. They were right. But I guess I had to learn that mistake on my own. But, I was a kid. I was 15. I didn't, I was adolescence, all that. So, sometimes people have to make those mistakes for their own. But when it comes to trading, you don't have to make the same mistakes that killed everybody. They call it tuition. That's the money you lose when you first start trading. And a lot of people end up losing everything right off the bat, but you don't have to. So if you're a beginner, don't fall into that mindset where it's like, hey, here I go, I'm going to lose all my money. If you exercise risk management, you don't have to. So definitely what you want to do is you look at the trade and you basically add up how much am I going to lose versus how much I am going to win. So for instance, let's say you we're taking an unleveraged trade, right? You're just buying spot Bitcoin, which means you're not using leverage. And you buy 1 Bitcoin right now at 9,500. You have to come up with a plan. What are you doing with that position? Are you going to hold it to 100,000? You have to decide what's a realistic area where I'm going to take some profit off or close the trade outright. So let's say you buy 1 Bitcoin for 9,500 and you want to sell it at 12,000. So that would be a gain of $2,500. Now, how much are you willing to lose before you decide, hey, I'm wrong, I'm out? Meaning, where is your stop loss? Let's say, and I don't recommend this, but let's say you're going to become bearish if it goes under 9,000. If it goes under 9,000, you're out. So basically, you're risking a loss of $500. But if you win the trade and it goes to 12K, then you're going to make $2,500. So 2,500 win, $500 loss. That would be a 5-to-1 risk reward, which is a type of setup that I like to take pretty often. I like to go for trades that are 5R, 6R, or more. And if it so happens that target hits, you don't have to close the whole position, because if it's a winner and the trend is in your favor, you can ride it and make more. But if it gets to that target, you definitely want to take some profit, so that now you're not like taking a crazy amount of risk anymore. You've actually, in essence, not taken any risk. You've made money, and now you're letting a portion of your position continue to run. So, you know, the beauty of picking setups like that is, you know, you don't have to win them all. You can win 30% and you're crushing it, because when you win, you're making a 600% gain versus what you're risking. Now, what you need to do is decide what the probability, and this is by, you know, journaling and taking notes, and documenting what percentage is your hit rate. How often are you winning these trades? You can take all the 6R setups you want, but if you're losing 99% of them, then it doesn't make any sense. So that's really for you to figure out. But the key here is, when you enter a position, it doesn't matter what it is, an altcoin, Bitcoin on leverage, stocks, you have to have a plan. You can't just press the button and say, I'll wing it, I'm going to figure it out. I'm telling you right now, it's a recipe for disaster. Do not do that. The last part of this risk management and stops rule is, when you are making your plan and you have your trades structured and the setup is right, if it goes wrong, don't change anything. Don't move your stops. Like, it goes against you and now it's at 9,100 and you're like, oh shit, I'm going to get stopped out. Now you move it to 8,800. So now your risk management has kind of changed a bit, because now you're risking 700 instead of 5. But then guess what? It dumps below 9K and you're like, let me move it down. Before you know it, your stop is at 8,500 and you've been liquidated. So, you know, because when you're doing it in the heat of the moment, that's all emotions. You're thinking very fast with your heart, and you're watching the price move. And that's exactly what the market is designed to do, is to get you emotional and screw you and kill you. And, you know, always stick to your plan. That's the most key part of this, is you come up with a good plan when you were not emotional, but then when the market changes, you know, you end up doing something stupid, and that ends up catching the most seasoned and successful traders too. It's happened to me. It's happened to a lot of my friends, and it's just something that I just will not do anymore. If I put a stop there, that's where it is. If I lose, I lost. And, you know, being that I'm not risking a crazy amount of trade per trade, because I know I'm going to, in the long run, continue to win these trades, I have to stay in the game. So losing is not a big deal to me. We lose all the time. So yeah, that's it. Let's go on to rule number 2. Do not get killed by fees. This is kind of underrated. Some people that are new to this don't realize how significant this can be. But when you are trading, especially on a leverage exchange, you have to pay very close attention to your fees, or they will eat you up. Because simply for the fact that, depending on how much leverage you use, the fee is actually coming out of the position size. So let's say you're risking 0.1 Bitcoin, but you're doing a 10x trade. You're actually paying fees to enter it on a whole Bitcoin, as opposed to the 0.1 that you're actually risking in the margin. Now, why does that matter? Depending on how much leverage you're using, or if you're using cross, bigger position, you could be paying as much as 10% to market in. And what do I mean by market in? You see this right here? This is called the order book. Right now it's sitting at 9508 and 9507.5. The quantity is the size of the orders available. So let's say you're feeling FOMO and you're like, I got to get in this right now. You can choose to do a market order, which means you just buy the closest order on the book. And what happens is, the person who is making the purchase, either the buy or the sell, that's initiating the trade, is called the market taker. The person who has the order there is the market maker. And you go look on your exchange, look at the fees. The market maker is most of the time actually getting paid. So you're getting paid because you had your order there and somebody initiated the trade onto your order. Meanwhile, the person that's market buying or selling pays that big hefty fee. So, you know, sometimes you may need to market buy. I've done it. I think most of us have, but I found that if you're going to do it, I prefer to do it on the way out. If I see something happening with price that makes me feel like I need to get out or get in or whatever, well, get out, yeah, it would be. But, circling back to rule number one, it's not always great because it's an emotional decision. But, you typically want to just structure your trades and set your limit orders so that you can get paid for the trade, and you're not immediately behind the 8 ball. When you mark it in, you're already in the hole. So make sure you're structuring your trades, you're setting your limit orders, and even if the price is starting to move pretty quickly, it almost always comes back. So don't hesitate to let it run away from you. You don't want to lose money. You know what I'm saying? So when you mark it in, most of the time it's done with emotion. You're chasing something, and you're also getting hit with a hefty fee. The second part to this one is funding. Okay, so if you're trading perpetual swaps, you see this right here in the corner, funding rate. And this is one note about Dudex. It's a relatively new exchange, and from what I could see, it's like bull heaven, or bull mania, bear heaven rather, as opposed to bull heaven, because everybody's a bull on this exchange. This funding rate is crazy high, 0.25. So it's like every 8 hours for being in a position, you have to pay funding. So 0.25 is extremely high. Like, you can't even sit in that for too long, or it's going to like eat up your whole position. Normal funding, like the average funding it's usually around like 0.01, 0.02. But what happens is when more people are in one side of the trade, the funding ends up paying the other side. So when it's 0.25 like this means that longs are paying shorts. So if you're in a short position every 8 hours, you're getting a nice fee paid to you for holding that position. If this is negative, that means it's favoring longs, meaning the shorts are paying the long, so you're being paid to be in the long. Now, we use this in trading because if the funding is too high in either direction, it would kind of indicate that the majority of the market has taken one side and it's kind of heavy on that side. And, normally I don't want to be with everybody else. So if funding gets over like 0.05, 0.06, I start to pay very close attention to what price is doing. Usually, and listen, funding can be very high for a long time. Just like the same, you don't just trade off of funding, but it's something that you keep an eye on. The same way RSI can be topped out, but topped out for months. If you look at 2017, the RSI was like over 80 for a very long time, and funding was high for a very long time, but, bulls were killing people. So it's not, a deal breaker for a trade for me, but if I'm in a trade and Bitcoin, let's say you entered Bitcoin at 8,300 and a week later now it's 9,500, it's gone up $1,200, and when you entered the funding was even, and now the funding is 0.2, it's probably a good sign to take some profit. Now, if you want to do a longer term position, and let's say you get a great entry and you got in at 6,500 and you really believe Bitcoin's going to 20,000 or higher, and you want to hold that position, then you want to look for a futures derivative product. So like a Bitcoin futures trade. You can take if you're trading futures, a futures contract, then there is no funding. So that's kind of like a plus for trading futures. But if you're trading the perpetual swaps where the liquidity is, you're going to get hit with that funding. So be careful. Last one is liquidations. So you should never really be in a position where you're going to get liquidated, to be honest. Like that should be rule number one. Like, don't get liquidated. But if, let's say you find yourself in that position where you kept moving your stop loss and all of a sudden you're on the verge of being liquidated, you want to put a stop like at least $15 above your liquidation or below. If your liquidation is 9,500 and you put your stop at 9,505, guess what? When it goes down there, it's not, your stop isn't going to hit. It's going to run right through your stop and it's going to liquidate you. And when you get liquidated, you get hit with extra fees. So, especially if God forbid you're on cross where you're risking your entire account, $5 difference, like you could be stopped out or liquidated. It may cost you a huge amount of money. So do not get liquidated on cross. Do not get liquidated, period. It should never even get that close. But if you happen to find yourself in that situation, you can either close it manually, or move your stop to like give it at least $15. Sometimes $15 you're not even safe. If it's a violent move, like you'll get hit with crazy slippage. So people that, and this is another thing, like when you're placing your stops, if you're in a price point that's going to, and this comes with experience, but you have an idea of different price levels where if it gets through, there's going to be a very violent reaction. Like, so for instance, the 9,200 the other day, I saw people in shorts getting stopped out. They had their stops slightly above 9,200, but in a 1 minute candle, it went up $200 and people got hit with $200 worth of slippage. So you have your stop at 9,200, but you actually get filled at 9,400. So let's say your RR on that trade was like you shorted 91.80 and your stop was 92.10. You're only, in your mind, you're like, hey, I'm only risking a $30 move against me, and then it ends up being $230. I mean, it totally screws you over. So another thing is be careful when you're trading very significant price levels because the slippage will be brutal. But yeah, don't get liquidated. Okay. Number 3, the trend is your friend. Just like what I said earlier with basic stuff that people tell you and you ignore and make the mistake, this is one that even the beginners know this one. The trend is your friend. Everybody knows it, but not everybody observes it. So let's look at a chart here. So you see this? A trend is 2 higher highs, 2 higher lows, or vice versa. So we have the high here, then you have a low, then you have a lower high, then you have a lower low, then another lower high. So at this point, you should be realizing, hey, the trend is bearish on the daily. Now, you got to keep in mind, there are different resolutions. So you're looking at hourlies, there are all sorts of trends within trends. So it depends on what you're trading. But on the daily here, at this point right here, you should know that this is starting a bearish trend. We make a higher low here and then a higher high than this, but we still haven't taken out this high or that one. So this is a fake out. This is a bull trap. Then you get a low, lower high, lower low, same high, and then when this level breaks, that's when it really kind of dumps down. But somewhere in here, you need to be identifying, okay, this trend is kind of looking bearish now. And you got to look and see if this top can get taken out, then this uptrend that had originated here with the low, high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. You get it? So there's a nice uptrend going in, but then when it makes this crazy move up here to 14K, you get a big dump and then a lower high. At this point, really here or here even, you should be considering, hey, maybe this is going to reverse. But at the same time, don't get wiped out because the trend is still bullish. Wait for that confirmation for a trend reversal. So fast forward to over here. You have this low is set. You make a high, a higher low, a higher high, a higher low. So at this point right here, you should be really kind of paying attention and say, okay, it looks like the trend has, at least we're in an uptrend right now on the daily. So you can trade this. We made the higher low here at 8,300. This is where I signaled in my group, hey, let's start getting in now. This level held. People are expecting the worst, but the trend is your friend. And don't get killed by it. So very simple stuff, but it will save you. In 2018, I made the mistake. I didn't understand it. I was trading against the trend. I still thought we were in an uptrend when we were very clearly in a downtrend. And I'm going into every bounce and then getting killed each time. Lower highs, lower lows, until it finally falls out and capitulates. So the same things will happen over and over and over. Make sure to try to identify the trend as early as possible and then just ride it until it's over. Yeah, simple stuff. And lastly, oh, not lastly, we got 2 more. Number 4, control your emotions. As I alluded to earlier, the market is here to make us emotional. The price action in every asset, you can see it on the chart. I mean, as my mentor Kazanomics always says, that's what the chart is. It's people doing people stuff, and people do the same stuff over and over. So when you look at these charts, this is people doing stuff, and people are emotional beings. Not everybody's a sociopath. So you don't want to get into a structure where you're acting impulsively, gambler mentality, emotional. All of these things tie together. So if you have risk management and you're only risking 1%, 2% per trade, you shouldn't be too emotional, because if you lose the trade, it's not the end of the world. But if you're risking all of your account, or 50% or 30%, now you can't put your phone down. You're on the toilet looking at the chart. You know what I'm saying? And you can't sleep. That's a sign that you first off, you've used too big of a position, but secondly, you are emotional now. And controlling your position size will definitely help in reducing emotions in the market. And this is simple, but most people won't listen. Anyway, control your emotions. The other one that we circle back to is the market buying. See, everything's intertwined. If you look here, so this dip happens. It happens very fast right here to 66.80 approximately. And then the wick is bought up and it goes up fast. So you're sitting on the sidelines, or maybe you were longing this whole way down and getting killed. And now you see this kind of wick develop and it bounces up super fast. And somewhere in here, like 7,500, you're like, oh shit, here it's going for it. And then you market buy in, and then you put your stop. Okay, if these wicks don't get taken out, I'm going to put my stop right here. And hopefully this goes to the moon now. So you bought up here, chasing emotionally, and guess what? The price comes right back, actually takes out all of these people and makes a slightly lower low, then it takes off without you again. So, you can play this on multiple time frames, but more often than not, when you get like a big wick or like a fast move in either direction, the price tends to come back. So like this type of a move is something that you'll see on every chart in every time frame, and that's a real gem for you. That one can save you from getting killed pretty often, and especially when price gets to significant areas. Look for that one. And when it does it and then it holds on, that's probably a good sign that, hey, maybe this time it's going to work. So definitely pay close attention to that one. Don't revenge trade. Some people set limits of the amount of trades they can make per week. If you start over trading, you lose a trade and then you quickly re-enter the trade for whatever reason. I mean, I've done it. A lot of people have done it. We all do it. Don't do it. Just don't. If you lose it, cool off, step away, go to sleep, put the phone away, and, tomorrow's a new day. There's always a market, there's always an asset, and you don't have to become rich overnight. I mean, that's the mentality that kills people. So don't do that. If you lose the trade, go back to the drawing board, make a plan, and look for the next trade. But first, take some time off, especially if it's a bad loss and you're feeling your emotions. That's a sign that you need to just step away. Because most people, I've seen people build their account for months and months and months, successful trades. They lose one bad trade and then they make another revenge trade. And like within one day, they've nuked their entire account. Like, it's not an exaggeration. People do that. So don't be that guy. FOMO is a killer as well. Kind of circling back to when you see that wick occur and you didn't have your limit order set and you try to market buy in on the way up, you get crazy slippage. And then the next thing you know, now you're in a bad position. That's the FOMO that will wreck you. Do not, if you miss the move, it's okay. There's always another trade. You know what I'm saying? Like, there's always more. It's not going anywhere. So stop with this mentality that one trade is going to change your life. It's true, it can, but you need to plan it. Those trades don't happen when you do it with emotion, okay? And the last one, rule number 5, is journaling. A lot of the things that I've discovered that have completely changed my trading game came from journaling. Kaz used to always tell me, journal, journal, journal. Every great trader says you must keep a journal, yet here I am not keeping a journal. I'm like, yeah, you should keep a journal, but I wasn't doing it. And as soon as I started to do it seriously, I noticed that the moves and trades and kind of mindsets that were killing me were the same. It was the same thing over and over. I was making the same mistakes. And when you journal, you're going to find yours is going to look different than mine. Probably we'll all have different things, but there are patterns and people are creatures of habit. So if you're doing something that's constantly killing you and costing you money, if you write it down and you read it and then you realize, hey, every time I do this, it's killing me, all you have to do is not do that. And it's going to save you a ton of money. You will be infinitely more profitable if you eliminate the habits that are costing you the most money. So, and then also, you don't want to just look for the bad, you look for the good. Hey, every time I did this, I won money. Oh, okay, this makes sense now. So a lot of different things, it took the journaling for me to really, that was like one of the key things that turned the corner for me, made me into someone successful and a profitable trader, was taking notes and identifying those key things that I was doing that was killing me. And one of them was this whole wick, trying to mark it into the wick. Oh, here comes the dump. Oh, let me mark it in. Let me move my stop right below the wick. And then it comes right back out and takes me out. That one was killing me. So, it took me, I had to write it down. The other one that was killing me was using too big of a position. That was a killer for me, as well as adding two winners. So I would structure a trade with good RR, good position sizing. It starts going in my direction. I get emotional now. I got emotional, and then I add to the position. Then I move my stop up. So what happened was I screwed up my risk management. I used too much leverage, so now I'm emotional. And then I moved my stop up to a place that I really probably shouldn't have put my stop, because then what happens next? I'm up huge. It's going great. Comes right back down, stops me out. I end up with nothing. Where had I just kept the original position and not added to it and not moved my stop, it would have came back, but then it would have took off, and I ended up being right by like a crazy amount. So, journaling helps you identify all these flaws in your game. So do not let anybody discount the importance of that. Well, no one will. Everyone will tell you how important it is, but a lot of people won't do it. So, take it from me. Do it. Just do it. And an easy way to do it, some people are like, hey, I don't like to write, whatever the case may be. This is what I did. I opened a Discord server. You can just, if you have Discord, you just click create new server, and it's just me by myself. And I do screenshots and I write notes to myself, and then you can organize it. You could put different channels. You could separate it from winners to losers, or whatever you want to do, however deep you want to get into it and organize. But as simple as creating a Discord server, screenshots of the trade, you write a little note, what you were thinking, why you took that trade, and you will start to see patterns very, very quickly. And if you review that and study it, that's like one of the most important things you can do. So that's it. Obviously, there's way more to trading than this, but I wanted to give you a little something to kind of get you started on your journey. For people that are serious about it and want to get more into trading and like having a group of people to bounce ideas off of and kind of point you in the right direction, I do host and run. I am the CEO of the Crypto Dojo. We're absolutely crushing it. I couldn't be prouder of the team and the guys in there doing some tremendous stuff. So if you're interested in joining, definitely check out the link in the description. If you like this video, give me that thumbs up, give me the likes, subscribe. I got way more content coming out. I know I've been slacking a little bit, but I've been so busy trading. So, I hope you enjoyed it. Throw me a like. And if you want to get started on Dudex, back to Dudex, sign up with my referral link. I would much appreciate it. Dudex.com/KoreanJew. This one, I'm kind of at the moment, being that it's bear heaven, I'm using this one to kind of hedge. So when I feel like shorting, because the funding is so good, I will short on this exchange. So sometimes also the premium is good too. So usually the price is higher on Dudex than other exchanges at the moment, and the funding is higher. So if you're a bear, definitely get on there. There's a lot of good opportunity for shorting, but this trend is kind of bullish, so it might backfire as well. Anyway, sorry, threw that in at the last second, but I hope you enjoyed the video, and stay tuned for some more. Take care.
Give me that.
Crypto Quickie.